Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us at the MarketSite studio, we have Kevin Mahn, Chief Investment Officer at Hennion and Walsh Asset Management, to discuss lessons learned in 2022 and what to look forward to in 2023. Kevin, it's great to see you as always. Welcome back to Trade Talks.
My pleasure, Jill.
And before we get into what we've learned in your outlook, what was your reaction to the Fed yesterday?
Well, the Fed did exactly what we thought they were going to do. They raised rates by 50 basis points, and they indicated and reiterated their stance, their firm stance in continuing the fight against inflation. However, what took everybody by surprise, seemingly, was that they moved their terminal rate up to 5.1% and suggested that they may need to keep rates high for longer to tamp down inflation. Now, let's put all that into perspective, right? The Fed meets 8 times a year, 4 times in the first half of the year, 4 times in the second half of the year. So let's say, for argument's sake, during the first 3 meetings of 2023, they raised rates by 25 basis points each. Not too much, and less than what they've done in December, and certainly the 4 prior meetings with their 75 basis point hikes. That brings the Fed funds target rates of 5 and 5 1/4, exactly what their terminal rate is suggesting. And then they pause. I know the word pause, everyone freaks out about the word pause, but they pause at the end of the first half just to see the total amount of damage they've done to the U.S. economy with these very aggressive rate hikes. I think that's going to be significant. I think the economy goes into recession, and investors would be wise to brace their portfolios for that type of economic slowdown.
And it seems as if the market almost has a disconnect. The market wants something else, and the Fed's telling you, well, that's not what we're giving you. And of course, the Fed's mandate is not the market as much as it is the economy. So what are your thoughts on what the Fed may or may not do for 2023? Do you think it's prudent that they stay the course and not shift policy too quickly?
Yeah, I mean, we must remember that the Fed has 3 tools in their arsenal to help fight inflation. We always talk about the first 2, right? Their balance sheet. And right now they're shrinking their balance sheet to the tune of about $95 billion a month. Their second tool is raising the Fed funds target rate. They raised it 425 basis points already this year, and in all likelihood they'll raise it by another 75 basis points next year, perhaps more. The last tool they have in their arsenal is their rhetoric, and that was certainly on display yesterday when Chair Powell came out during his press conference and kind of dampened all the hopes that perhaps the Fed was turning more dovish. So I think they go up to 75 basis points next year. They continue to draw down their balance sheet, and then they're going to pause and reflect on the damage that they've done. Everyone's hoping that rates get cut at some point next year. I think that gets pushed into the first half of 2024 unless they continue to raise too aggressively, pushing the economy into a deeper recession than would have occurred on its own, necessitating the need to actually cut rates later next year.
So how would you summarize 2022, and what can investors learn from what's been a volatile market? Because it's been over a decade that we weren't buying the dip, and it was a year of prolonged volatility.
Absolutely. I think most investors are happy to close the door on 2022, and I think it's fair to say at this point in time that the worst is now behind us. The worst with respect to this particular rate hike cycle. We know we've now hit peak hawkishness, and by extension we've hit peak inflation with those moderating levels of PPI and CPI. As we look forward to 2023, perhaps better days are ahead for investors, but not necessarily the case for the economy. I think the economy is going to contract further at the first half of 2023, but if history serves as a precedent, generally the market bottoms about 6 to 9 months prior to the recession ending. So at some point in time in the early stages of 2023, perhaps even right now in 2022, there could be some good opportunities for investors to consider.
And I think that's a great lesson that's learned. The market and the economy are 2 very different things, and investors need to recognize that. So as you look ahead, where do you see investment opportunities for 2023? Because managers got to put their money to work somewhere.
Absolutely, and I think the first place we would look to is some of those more defensive sectors right out of the gates. Areas such as healthcare, utilities, and even consumer staples. Healthcare can be accessed through 2 ways: your traditional large cap pharmaceutical names like the Mercks and the Johnson & Johnsons of the world, and then through the smaller cap biotech names, the types of companies that are providing all the innovative healthcare solution that society needs to fight all of the rare chronic diseases that are still out there that don't have therapies and certainly don't have remedies just yet. And then you go into the utility space. I know utilities are boring, right? But they pay attractive dividends. And even during periods of recession, individuals need to pay to keep their lights on and pay to keep their houses heated. So utilities can be a good home during periods of economic slowdowns. And of course, consumer staples. We still need to shop, even though food prices are going up higher. So those are the names that we like in the first half of the year. And then maybe starting to dip into those more beaten up areas of consumer discretionary and technology later in the year.
Yeah, could be a fun year for active managers
It's
for
going to
sure.
be a fun year.
All right, Kevin, appreciate the insight as always. Thanks for joining us on
Thank
Trade
you.
Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.